All right, welcome back. This is Module 11 of the Speed Banking class. In this module, we're going to be talking about your emergency funds. So let's go ahead and dive in. As usual, we got to share our disclosure. I'm not a licensed attorney, accountant, financial advisor, broker, agent, or any other licensed individual. Just have a really cool strategy that I want to share with you. This should not be construed as any specific counsel, advice, or instruction that would apply to specific individuals. It's intended just to be general information for educational purposes. So please take it that way. Now, if you remember this slide from when we talked, I think in module, I can't remember what module number, but it was earlier on when we were talking about the difference between how the employee mindset individual saves versus how the wealthy mindset individual saves. The employee mindset likes to use the accumulation strategy mostly because that's all they were ever taught, right? Build the nests, put the eggs in the nest. The wealthy use assets instead. So when we're talking about emergency funds, there are better ways to do it than the accumulation strategy. I would say almost never will you use the accumulation strategy as a way to save for something. In your wealthy mindset, the wealthy, and I'll give you a few examples. The wealthy use assets to build their retirement, cash flowing assets that will continue to pay them every single month once they retire. And that's the much better way to do it because you're building equity, you're getting that monthly income, you're getting appreciation, you got tax advantages by having assets over having savings. It's just a better situation all around. There are also things you can leverage, so all around having assets is a much better way to retire than just the simple accumulation strategy of putting eggs in the nest. Also, emergency fund. So emergency fund, in my opinion, the best way to have an emergency fund, which is just some money that you have available to be able to spend on an emergency room visit or a new set of tires if something happens or whatever the case might be. In my opinion, the best way to do that is the speed banking strategy. Now, you might want to have some cash reserves in your house, and that's fine. Hide some cash in the cellar or whatever. But as a general rule, I think speed banking is a much better way because it takes that emergency reserve and it puts it to work while you're not using it. So you definitely want to utilize the speed banking method for your emergency reserve over your accumulation strategy. Now, here's a few rules of thumb for your speed banking emergency fund. Use a tiered reserve system. So what I mean by that is start with a small amount. We talked about starting with maybe $1,000 and work your way up to 6 to 12 months of income as your reserve. If you can start out with that 6 to 12 months, great. But most people aren't going to be able to do that. Most people are going to have to start out and tier up to that 6 to 12 months. So start out with something small, $500, $1,000, and tier up to your 6 months to 12 months of income. Start with enough room to cover 1 month of expenses. Mentally earmark that amount in your line of credit for emergencies and never spend beyond that, obviously, except for in emergency situations. Never chunk into your emergency reserve. So back to our example of a $5,000 line of credit, a $5,000 credit card that we're using as our speed banking tool. If you set aside $1,000, then your chunk's only going to be $4,000 maximum. You're never going to chunk into that $5,000. So if you've paid it down to $500 and your emergency reserve is $1,000, then you're not going to chunk $4,000 because that'll put your total balance at $4,500, and that eats into that emergency reserve. So make sure that you only top out at that $4,000 if in this example. Your available credit should grow every month, increasing the amount available to you to use for assets or emergencies. So even though you've only got that, and this is particularly true in the flip method, not necessarily so much in the chunk method. So the never chunk into your emergency reserve, that applies to chunkers, and then your available credit should grow every month. That applies more to flippers, to the people using the flipping debt method. And then never use your emergency reserve to purchase assets. So if you've got, let's say you're using the flipping method and you've got $100,000 in debt and $50,000 in available credit, and 20,000 of that is set aside for your emergency reserve, that only leaves 30 to invest in assets. If you have an asset come around that you need 50 for, fight the urge to dip into that emergency reserve because that is there for emergencies. It's not there for assets, right? Always keep your emergency reserve. The money that the leverage that you create by paying down your debt will be your asset reserve. So, just The point of all this is make sure that you treat those emergency funds as sacred. You'll be grateful you did in emergency situations, or you're going to be stressed out if you don't, right? So can't say I didn't warn you. Make sure that you're protecting that emergency fund in the case of emergencies. That wraps up our emergency fund module. This has been module 11. In module 12, we're going to be talking about how to work with the bank, what products to use, how to talk to them. That's all going to be covered in module 12, so we'll see you over there.